market is still trying to find its footing from last week's decline. In our market brief, we're going to continue with last week's look at key levels on the charts and get an update on the health of the market. First, we'll look at a summary of this week's economic data and interpretation. This week we saw more record-breaking economic data, particularly on the employment side. The JOLTS job report openings reached the highest level since recording began in 2000. Unemployment claims headline numbers reached the lowest levels seen since 1973. Even housing showed mixed data and a little bit more of a positive note. The housing index was up on sales, demand, and expectations, and housing starts outside of areas impacted by Hurricane Florence increased by 3.8%. Leading economic indicators were also up, and we'll cover those after the week in review. While the economy remains very strong, sources of concern weighing on the market include the Fed's views of full employment, global debt, and trade disputes. In keeping with our look at economic data, once a month we get the leading and coincident economic indicators from the Conference Board. These are a useful gauge of the strength of the economy and momentum. A drop below zero in the momentum series at the left usually coincides with a recession. The peak in May is a lower high in a series of lower highs going back to 2010. The current value in the series is above 3%, and the momentum series could certainly turn back up, but it's worth keeping an eye on. The individual series shown in the graph at upper right and the ratio of the series shown at the lower right are still strongly trending up, and more concern would be warranted if we saw declines across the board. Now we'll look at our week in review, where we take a look at the headlines and how they move the market. On Monday, tech stocks led the indexes lower. On Tuesday, earnings and a new all-time high jobs report drove the markets higher. On Wednesday, the market paused to digest Tuesday's rally and weigh earnings and rates. On Thursday, the rally faded on concerns over global growth and debt, particularly focused on China. On Friday, the market struggled in the face of a continued decline in technology stocks. The market closed roughly flat at up 0.07% for the week, and the month and year-to-date statistics are provided at lower right. In our market brief this week, we're going to look at key levels on the chart that we noted last week, and we're going to check the health of the market. This was a volatile week, and keep in mind that all of these charts are as of 12 p.m. or later on Friday afternoon. This is a daily chart of the S&P, and last week we noted the Fibonacci retracements shown in the chart in blue from the February low to the most recent high. Notice that we reclaimed the 38.2% retracement, which cuts right across from the March through the June highs. This area was being tested as resistance and now potentially as support. We broke above this zone that we highlighted last week that was bounded below by the 200-day moving average and above by the 38% retracement. So far in today's session, price is holding above the 38.2% retracement, and this candle is actually improved at the time of this recording somewhat. The candle now is a more indecisive looking candle. Looking at a weekly chart of the S&P with our two consolidations shown in gold, last week we tested the bottom of a rising channel from the 2015 through 2016 correction, and we also held this green line from the January high to the June highs. Last week we had closed below the March to mid-June highs. As of 1 o'clock we were above this level, and if we close above it, it will become support. The long-term trend is still up, although we want to keep a closer eye on the spacing and slope of these moving averages. This is a daily chart of the S&P that we post on Twitter and we call our Clearview chart. This is our charting method using outside bars and gaps to show inverted triangles that price is trading in. Starting from the peak in January to the current correction, price corrected within this range. Looking at the March gap through the April gap and the June outside bar, we have a lower line bordering this zone. We can draw the upper border from this April outside bar through this May gap, late May gap, and June outside bar. And this creates the range that we're currently trading in. On a short-term basis since the October low, we've made a higher high and a higher low, which is somewhat encouraging. On a longer-term basis, we still have a rising 200-day moving average and support for this zone from the longer-term trend. We'll go into next week prepared for continued volatility and watching for continued progress. information in this video cannot address the specific investment objectives, financial situation, or particular needs of any viewer. The information presented is solely for informational purposes and is not a solicitation or offer to buy or sell any security or financial instrument. None of the information in this video should be taken as investment advice. Any opinions expressed in this video are subject to change without notice. Caliber Capital Management, LLC, or KCM, is not under any obligation to update or keep the information contained in this video current. KCM, its officers, employees, or clients may have an interest in the securities, related securities, or derivatives of the securities referred to in this video. KCM accepts no liability whatsoever from any loss or damage of any kind arising out of the use of all or any part of this material. KCM recommends that you consult with a licensed and qualified professional before undertaking any investment decision.